Welcome back to the Deep Dive. It is Friday, January 30th, 2026. And if you've been watching your portfolio today, specifically SoFi Technologies, that's ticker SoFi, you're probably feeling a little bit of whiplash.
I think whiplash is the perfect word for it.
On one hand, you have this massive, psychologically huge milestone. They've done it. They've officially broken $1 billion in quarterly revenue.
It really feels like a graduation day. I mean, hitting $1 billion in a quarter is the moment you stop being just a fintech concept and start becoming a legitimate, heavy-hitting financial institution.
Right, you're moving from that growth-at-all-cost startup to a real compounding powerhouse.
Exactly.
And yet, despite all that, the market's reaction today has been, well, let's just call it chaotic. The report drops, it's a double beat on top and bottom lines. The stock jumps, what, almost 6% in the pre-market?
The champagne corks were definitely popping early this morning.
And then the opening bell rings, and it just craters. Down about 4% intraday. It feels like a classic sell the news event, but I think there's more to it. I think there's genuine confusion over some of these accounting numbers.
I think you're right. This was not a clean report where every arrow was just pointing up in green. You have that record revenue, absolutely, but then you have some year-over-year comparisons that, if you don't have an accountant sitting next to you, look genuinely ugly.
And that's exactly why we're here. Our mission for this deep dive is to strip all of that noise away. We've gone through the earnings release, the filings, the analyst notes, and we've put it all into a 5-slide framework to figure this out.
So the big question, is this drop a sign of fundamental deterioration, or is this just the market misreading a very, very complex spreadsheet?
I think we both know the answer, but let's prove it. Let's start with slide 1, the at-a-glance scorecard.
Okay, so this is where we just look at the big headline numbers versus what Wall Street was actually expecting.
All right, let's start with the undeniably good news. Total revenue. It came in at $1.05 billion, a record.
And more importantly, that's up 40% year over year.
Which is just a massive number.
It is. And just to put that in context for a second, analysts were looking for something between, say, 973 and 982 million. So this isn't just a beat.
It's not a rounding error.
No, it's a solid 4.4% beat above expectations. You have to ask yourself, how many banks are growing their top line at 40% right now?
Very, very few.
Yeah.
So the top line is screaming growth. But then we get to the number that I think trapped a lot of investors this morning, the scary number.
A trap.
GAAP net income. It's reported as $173.5 million. And on the surface, okay, profitable, that's good. But the comparison to last year says it's a 48% decrease.
Right.
And I'm an investor seeing this, and I'm thinking, wait a minute, revenue's up 40%, but my profit got cut in half. That sounds like a disaster. It sounds like margins are collapsing. Why shouldn't I be selling everything?
Because what you are looking at is it's an accounting illusion, it is a mirage, and it's all caused by taxes. To get this, you have to rewind to Q4 of 2024, so 1 year ago.
Oh.
In that quarter, SoFi recorded this massive one-time non-cash gain. It was about $258 million.
This was the valuation allowance thing, right? We covered this back then.
That's the one. It's tied to deferred tax assets, or DTAs. Basically, because SoFi lost money for so many years as a startup, they piled up these tax credits.
Right.
Last year, the accountants finally said, okay, you guys are consistently profitable. We're going to let you count these credits as a real asset now.
So they basically cashed in a giant coupon last year.
A $258 million coupon. It's like finding a winning lottery ticket in your desk. It counts as profit, but it's not from operations. It was a one-time accounting entry.
So last year's number was artificially inflated by, what, almost $300 million?
Precisely. That game didn't happen this quarter because, well, you can only find that lottery ticket once. So when you compare this quarter's real operating profit to last year's inflated profit, of course it looks like a drop.
You're comparing a normal paycheck to a lottery win.
Exactly. You can't do that.
Okay, so what happens if we strip out the lottery ticket? If we look at the actual operational power of the business?
Now you're asking the right question, and that's where you look at adjusted net income. This number removes all that tax noise. And when you look there, profit didn't drop. It surged from $61 million last year to $173.5 million this year.
Wow. Okay, so that's a 184% increase.
There you go. The headline says down 48%, but the reality of the business is up 184%.
That is a massive discrepancy.
It is, and you see it in the earnings per share. They reported 13 cents, which beat the consensus of around 11 or 12 cents. So the operating engine is running hotter than ever.
It really feels like the trading algorithms just saw the scary headline and dumped the stock before any human could read the footnotes.
It happens more often than you'd think.
Okay, so the profit is real, but I want to dig into how they're making it. Because for profit to grow so much faster than revenue, that implies something powerful is happening with efficiency.
Which is the perfect lead-in to our next slide.
Slide 2, the engine of profitability.
And the big idea here is operating leverage.
I love this concept. Let's break it down for everyone. We just established revenue grew 40%, but the adjusted EPS grew, what, 160%? How does that math even work?
Think of it as the Jaws effect. Imagine a chart. Your top line, revenue, is shooting up like a rocket. Your bottom line is your expenses.
Okay.
Now, because SoFi is a digital-first bank, they don't have thousands of physical branches. To get 1 million new customers, they don't need to hire 1,000 new tellers. Their fixed costs, the app, the tech, the headquarters, they stay pretty flat.
So the expense line is going up, but much, much slower than the revenue line.
Exactly. And that gap between the two lines, the Jaws, gets wider and wider. And that gap is almost pure profit.
And we can actually see this in the margins.
You can see it clear as day. The adjusted EBITDA margin expanded to 31%. Last year, it was at 27%.
So for every $100 that comes in the door, they're keeping $31 before interest and taxes. That's a really healthy chunk.
It is, and it proves they're not just, buying revenue by cranking up the marketing spend anymore. They're scaling efficiently.
I have to play devil's advocate here, though. There's one little fly in the ointment. The report mentions a 17% increase in the number of shares outstanding.
Ah, yes. The dilution.
Right. And as a shareholder, that's the word you hate to see. The pie's getting bigger, sure, but they're cutting it into a lot more slices. Doesn't that hurt my investment?
It's a totally valid concern. When you dilute by 17%, your earnings have to grow faster than that just for the earnings per share to stay flat. It's a headwind.
For sure.
But here's the reality. Adjusted EPS still more than doubled. The earnings growth was just so explosive that it completely overwhelmed the dilution.
So the pie got so massive that even with a smaller percentage slice, you still have way more actual pie on your plate.
That's the math. And we'll get to why they diluted in a bit because there was a very smart strategic reason for it.
Okay, let's hold that thought. The engine's working, but let's look under the hood. Which parts are really firing?
Let's do it.
Slide 3, the engine room business segment performance.
SoFi really has 3 main pistons here. Let's start with the original business.
Segment 1, lending. This has always been the cash cow.
And it still is. Revenue was $486.5 million, up a solid 15%.
Now, coming into this report, the whole narrative was doom and gloom. The consumer is tapped out, a recession is coming, defaults are going to skyrocket.
And the data just doesn't support it, at least not for SoFi's customers. Personal loan originations hit $7.5 billion. That's up 43%.
Okay, but my worry is, are they good loans? It's easy to lend money if you don't care about getting it back. Do they just lower their standards to hit a number?
That's the billion-dollar question. And the answer is in a metric called net charge-offs. This is the percentage of loans that actually go bad. It came in at 2.80%.
Man, is that high?
This is the crazy part. It's actually down year over year.
Wow.
Think about that. We're in an environment where credit card delinquencies are rising everywhere else, and SoFi's credit quality actually improved.
That completely busts the bear case. It means their underwriting, their AI, it's actually working. It's finding the right people.
Exactly. They target high earners, people with FICO scores over 750. That's a resilient demographic.
Okay, so lending is strong. But let's get to the second segment, because this is where the real story is, I think.
Segment 2, financial services. This is the star of the show.
I mean, the numbers are staggering. Revenue of $456.7 million, up 78%. And the contribution profit literally doubled year over year.
This right here is the validation of that entire super app strategy. This segment includes the checking accounts, the credit cards, the investing platform. For years, the bears said this was just a money pit, a loss leader.
And now, it's almost as profitable as the entire lending business.
It's the flywheel effect in action. You come to SoFi for a great high-yield savings account. Then, since it's right there in the app, you open an invest account. Then you get the credit card. It costs them basically nothing to sell you that second and third products.
Zero customer acquisition cost on the cross-sell.
Right. And the numbers show it's working. Revenue per product is up 29% to $104. They are not just adding free users, they're successfully monetizing them.
All right, now we have to talk about the weird one, the curveball. Segment 3, the technology platform. This is Galileo.
The confusing one.
This is their B2B business. The report says accounts dropped 23%. A quarter of their customers just gone. The rumor is they lost a huge client, maybe Chime.
That's the rumor. And I mean, normally, a 23% drop in accounts is a 5-alarm fire.
So why aren't the sirens going off?
Because somehow, profit went up 49% and revenue went up 19%.
Wait, how is that possible?
Oh.
You lose a quarter of your customers and make almost 50% more profit.
It tells you everything about the kind of customer they lost. It was almost certainly a low-value, low-margin client. They were probably servicing millions of accounts that were either inactive or just not profitable.
So they shed all that dead weight.
And replaced it with higher margin business.
Yeah.
Their efficiency just skyrocketed. The margin jumped from 31% last year to 39% this year. It's addition by subtraction.
That's a fascinating pivot. Okay, so the businesses are firing on all cylinders, but what about the foundation, the bank itself? Is it safe?
Let's get into it.
Slide 4, financial strength and shareholder rewards.
Or as we like to call it, the balance sheet fortress.
And for good reason. Total assets just crossed the $50 billion mark. But the real story here, I think, is the deposits. They surged to $37.5 billion. That's up $4.6 billion in a single quarter.
This is the most boring and yet probably the most important part of the entire SoFi story.
So explain that. Why are deposits the holy grail?
It's all about the cost of funds. If you're a lender without a bank charter, you have to borrow your money from Wall Street on something called a warehouse line, and that's expensive.
It's like buying your inventory at wholesale prices just to sell it at retail.
A perfect analogy. But if you're a bank and you have customer deposits, that money is incredibly cheap. The report says SoFi pays 1.81% less on its deposits than it does on that warehouse debt.
And 1.81% on $37 billion is?
It's about $680 million a year in interest savings. That's the secret sauce.
Yeah.
That money just drops straight to the bottom line, all because they have a banking license.
Okay, so this brings us back to that dilution we talked about earlier. They raised $1.5 billion in equity. That's why the share count went up. And at the time, people were furious. Why raise cash if you're profitable? But now, looking at this, it seems like they took that cash and just paid off all that expensive warehouse debt.
That's exactly what they did. It's like they paid off a high-interest credit card with a low-interest mortgage. They took a short-term hit with the dilution to permanently lower their cost of funding forever.
A smart long-term move.
Absolutely. And look at the tangible book value. It's now $8.9 billion, which works out to about $7.01 per share.
And that's important because it acts as a kind of valuation floor for the stock.
Yeah.
If the price ever gets down close to $7, you're basically buying the assets for what they're worth and getting the entire growing business for free. It limits the downside.
Okay, so the foundation is rock solid. Let's look forward.
Let's bring it home.
Slide 5. The road ahead management's outlook and key takeaways.
Unsurprisingly, CEO Anthony Noto is feeling very confident. He's basically taking a victory lap, saying the one-stop shop strategy is now completely validated. And the guidance they gave certainly backs that up. For the full year 2026, they're guiding for about 60 cents in earnings per share.
Which, if you do the math, they just did 13 cents this quarter. So 60 cents for the year implies they expect this profitability to keep ramping up pretty aggressively.
And revenue guidance around $4.65 billion. That implies another 30% growth next year.
A 30% growth rate for a bank is just, it's almost unheard of.
Well, that's the thing. They have the safety of a bank, but they're still growing like a tech company. And looking even further out, from 2025 to 2028, they're committing to a 30% compound annual growth rate for revenue, and get this, 40% for EPS.
That is an incredibly bold guide. 40% earnings growth for 3 years straight.
It's a high bar. If they miss that, the stock will get punished.
But it tells you they don't see any slowdown on the horizon.
Okay.
They believe that flywheel is really just starting to get up to speed.
So let's boil it all down. What are the key takeaways for you?
I think there are 3. First, the profitability pivot is complete. This is not a concept stock anymore. They are a real bank generating real JAP net income, period.
Got it.
Second, financial services is officially the new growth engine. They're not just a lender anymore, dependent on the whims of interest rates. That fee-based recurring revenue is exploding.
And the third?
The stock volatility you're seeing today is almost certainly just noise. It's the market digesting that dilution and getting confused by the tax accounting. The fundamentals underneath it all are stronger than they have ever been.
It really feels like the market is driving while looking in the rearview mirror at that tax credit, while the company is looking forward at the open road of compounding growth.
And that gap between perception and reality is often where the best opportunities are found.
So here's my final thought, and this is what really gets me excited. SoFi has now proven that the super app model can work. And if that financial services revenue keeps growing at, say, 78% while lending grows at 15%, it won't take long, maybe 2 years, before SoFi just isn't a lender anymore.
It becomes a tech platform that happens to have a banking license. That's a completely different risk profile. Lenders get hurt in recessions. Stable tech platforms with recurring revenue, they don't.
Exactly. So the real question is, does Wall Street realize that the fundamental nature of this business has changed? Or are they still pricing it like a risky personal lender? That's the disconnect I'll be watching.
It's a fascinating evolution. I think 2026 is the year the market is finally forced to decide what SoFi actually is.
And we will be right here watching. As a reminder, none of this constitutes financial advice. Please do your own research. This content was generated by AI.
Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai.
For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines. Plus, our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.